Hello and welcome to CN Professional Institute. We are still on IES 8, accounting policies, changes in accounting estimates and errors. In this session, we are going to solve more questions. We'll be solving questions on changes in accounting policies. We'll solve questions on changes in accounting estimates, and we'll solve questions on errors, right? So we are going to solve questions on these three areas. So let's start. So let's start with question 3, right? So this is a question, you can take a shot of it and then we continue. So this is question 3. Question 3. Okay. So this is question 3 here. All right. So let's start. So question 3 says, while carrying out the audit of Brady Trading Limited for 2023, it was noticed that the depreciation on property, plant, and equipment for 2022 was incorrectly recorded in the books of account at 30,000 instead of 50,000 cedis. The extract from the income statement for the years ended 31st December 2022 and 31st December 2023 before correction of this error is as follows. So these are the statements before the correction of the error. We have gross profit, admin, selling, depreciation, net profit, income tax, and then net profit after tax. Then we are told that the retained earnings of Brady Trading Limited for 2023 and 2022 before correction of the errors, we have it as follows. And then they have their income tax rate. Brady Trading pays income tax at 20% for both years. Okay. And the requirement is this: we should redraft the statement of profit or loss and statement of financial position after correction of the error, right? So you have to correct the error and we redraft the financial statement. So the error with this question is that instead of recording 50,000 as depreciation, they recorded 30,000 as depreciation. So they have underestimated what? The depreciation. They have underestimated expense, right? They have underestimated what? Expense, which is depreciation. And you know what happens when expenses are what? Underestimated. When we underestimate our expenses, we increase profit, right? So when we want to correct this error, we have to go and less it because we have underestimated our depreciation. Instead of recording 50,000, we record 30,000. So we have underestimated what? Depreciation. And when we underestimate depreciation, when we underestimate an expense, profit increases, right? Because the expenses are less from revenue to get profit. So when we underestimate our expenses, profit increases. So we want to correct it from the profit side, then we have to go and less it from the profit, right? Now, before we start, let me just explain something to you small about errors. So if there's an error and the error will increase expenses, if the error will increase expenses, meaning profit will reduce because we are going to less higher expenses from what? Revenue, and so profit will what? Reduce. So if the error will increase expenses, profit will reduce, meaning if you are correcting it, go and add back. On the other hand, if the error will reduce expenses, profit will increase. Profit will increase. So when we are correcting, go and what? Less it. So what I said is that, okay, if the error will increase expenses, right, profit will reduce. So if you are correcting the error, go and add back. On the other hand, if the error will increase so we are saying that if the error will increase expenses, If the error will increase expenses, profit will reduce, right? If the error will increase expenses, profit will reduce. So when you are correcting, go and add it back to profit. If the error will reduce expenses, if the error will reduce expenses, profit will do what? Will increase. Profit will increase. So when you are correcting, go and do what? Go and less it. Profit will increase. And so when you are correcting the error, go and what? Less it, right? And then the tax element, this is how we treat the tax element. If you correct the error by adding it to profit, by adding the error to profit, you have to less the tax element. And when you correct the error by lessening it from profit, you have to add the tax element. So it's the other way around. I'll explain to you when we are solving the question so that you get it better. But if you correct an error by adding the error, the tax element should be what? Lessed. And when you correct an error by lessening it, the tax element should be what? Added, right? We'll look at it more. Also, when you look at errors involving inventory, okay, normally our cost of sales, we have our opening what stock, right? We have the opening stock. We add purchases. If you remember, we add what? Purchases. And then we less closing inventory. This is how we get cost of sales, right? And then we said we are going to less the closing stock. Now check this out. If we, because we are adding opening stock to purchases and we less closing stock, if we overestimate opening inventory, what happened to cost of sales? Cost of sales will go up because we add opening inventory to cost of sales. In calculating cost of sales, we add opening inventory. So if opening inventory increases, if opening inventory what increases, cost of sales what increases. And if cost of sales increases, cost of sales is an expense. So when cost of sales increases, profit is what? Reduced. So first of all, before you can correct the error, you have to get the impact first before you can correct the what? The error. So we said if the error increases opening stock, cost of sales will also increase and profit will reduce. So if you are correcting it from the profit side, you have to add it back to what? Profit. On the other hand, if you are correcting the error in cost of sales, determine the impact on cost of sales so that you can correct the error inside what? Cost of sales. So we said when opening inventory increases, cost of sales increases. So if you are correcting the error in cost of sales, you have to less it from cost of sales. Because if you make an error and then the error will increase opening inventory, cost of sales will increase. So when we are correcting the error in cost of sales, we have to less it from cost of sales. That's it. So here we are going to be solving it, and then the impact will be doing two corrections. Either we'll correct the error inside the expense, that's the cost of sales, if it affects cost of sales. So we're correcting the error in the expense side, or inside the hope that inside the profit or loss itself, and we'll also be correcting the errors using the profit, using the net profit. Okay, so we're correcting the errors in the expenses or with the expenses, and we'll be correcting the errors with what? The net profit. So we'll look at how it is. So determine the impact and then you do it. With closing inventory, to get cost of sales, we less closing inventory, right? We opening stock, we add opening stock, we add purchases, and we less closing stock. If you increase closing stock, if you overestimate your closing stock or your closing inventory, what is happening? You are reducing cost of sales because we are going to deduct a bigger figure, right? So if you overestimate your closing inventory, if you increase your closing inventory, if the error will increase your closing inventory, you are reducing cost of sales. So if you want to correct it inside cost of sales, they have to add the error back to cost of sales. Are you following? Very good. Now we said we less closing stock to get cost of sales. So if we overestimate our closing stock, we said cost of sales will reduce. If cost of sales reduces, what happens to profit? Profit increases because we less cost of sales from profit. So if our cost of sales reduces, profit increases. So if you want to go and correct it from profit, you have to go and less it from profit. You go and less the error from what? Profit. You have to go and less the overstatement from what? From the profit. So you have to determine the impact of the error on cost of sales and then the impact on what? Profit. So how you can correct it. Are you correcting the error inside cost of sales, or are you correcting the error in using the net profit or in the net profit? Right. So you should know these things and then their impact. What is the impact when you overestimate your opening stock, either on the cost of sales or on profit? And then what is the impact if you over or underestimate your closing stock on cost of sales and profit? Let me pick opening stock again. Let's look at underestimation. When you make an error and the error will reduce your opening stock. If you have underestimated your opening stock, you have reduced your opening stock. What happened to cost of sales? If you reduce your opening stock, cost of sales what? Reduces, because we will add opening stock to what? Cost of sales. So when you underestimate your opening stock, cost of sales reduces. So if you are correcting the error inside cost of sales, you have to add it back. You have to add the underestimation of the opening stock. You have to add it back to cost of sales. Because we said when you underestimate your opening stock, you are reducing profit. Sorry, you are reducing your cost of sales. So when you reduce your opening, or when you underestimate your opening stock, you are reducing cost of sales. And when cost of sales is reduced, profit increases. So if you are going to correct the error inside profit, okay, we said when you um underestimate your opening stock, when you underestimate your opening stock, cost of sales reduces. When you underestimate your opening stock, cost of sales what? Reduces. And when cost of sales reduces, profit increases. Profit will increase because we are going to less the cost of sales from revenue to get the profit. So when we are deducting a lesser cost of sales, profit will what? Increase. So if you want to correct the error in profit or in the net profit, you have to go and less it from what? The profit. And if you want to correct the error in cost of sales, you have to add it to cost of sales. So these are some of the things you need to know so that errors will become very easy for you, right? Now let's start with question 3. Let's start with question 3. Right. So question 3 says, while carrying out the audit of Bready Trading Limited for 2023, it was noticed that depreciation on property, plant, and equipment for 2022 was incorrectly recorded in the books of account at 30,000 instead of what? 50,000. The extract from the income statement for the years ended 31st December 2022 and 31st December 2023 before correction of this error is as follows. So we have the profits, admin expenses, selling, depreciation, net profit before tax, income taxes, and net profit after tax. And we are told that the retained earnings of Bready Trading Limited for 2023 and 2022 before correction of the error is as follows. So we have the retained earnings, we have the opening balance profit for the year, and we have the closing. Bready Trading Limited pays income tax at 20% for both years, and the requirement is we should redraft the statement of profit or loss and statement of financial position after correction of what? The error. So here the error is with depreciation. The question said, okay, instead of recording 50,000 as depreciation, they have recorded what? 30,000 here. So instead of recording what? 50,000, they have recorded what? 30,000. Are you following? So there's an underestimation of depreciation. Depreciation has been what? Underestimated. Expenses have been what? Underestimated. And when we underestimate our expenses, when we reduce our expenses, we said profit what? Increases. So we want to correct the error from profit, we have to go and less it from what? Profit. Are you following? And then the tax element, if you are correcting the error by adding the error, the tax element should be less. And if you are correcting the error by lessing the error, the tax element should be what? Added. So it's the other way around. Okay, very good. So here let's start. Let's redraft for 2022. 2022, there's an error with 2022. So let's start with, let's do 2022 first. Then when we are done, we'll come and look at 2023, or we can even look at both together. So let's start 2023 here and then 2022. Okay, So the first item we have there is they brought the gross profit. So we have the gross profit. The gross profit 2023 is 400,000. And that's not affected. Profits not the gross profit is not affected. 400,000. 2022 is 350,000. I hope you can see the figures. Okay. So I just bring the gross profit from the question. Then we have set general and admin. So general expenses. General 2, there's no mistake with the general. Okay. We have 80,000 for 2023. And then we have 90,000 for 2022. So 2022 we have 90,000. Okay. So we're just working on them. Then we have the next expense as uh selling. So we have selling expenses. So selling for 2023 we have 50,000. And then 2022 we have 2022 all 20,000. So there's no error with the general and the selling. The error is with depreciation. Okay. The error is with depreciation. So let's come to the depreciation. And with depreciation to 2023, there's nothing. The error was with 2022 depreciation, as stated in the question. So 2023 was the number 50,000. Okay. 2022, they said instead of recording 50,000, they recorded what? 30,000. So now we have to record the right one, which is 50,000, instead of the 30,000 that they have what recorded. Are you following? So we are done correcting the error. This is very simple. Okay, very, very simple. Instead of recording 50,000, they recorded 30,000. So you just have to go back the depreciation for 2022. Instead of recording 30, record 50. This method one, right? Now let me name this one method one, because we'll look at the other method where we said we can correct it from profit. So this method one. So you just have to underline this stuff here. And then when you are done underlining, you get your adjusted profit before tax, right? Okay. So what's our net income before tax? So we have the net income, okay, before tax. So just write net income before tax. So when you do your computation, 220,000, say for 2023, nothing has affected 2023. So the figures will still be the same. It's 2022 that will now get 190,000 instead of they recording 210,000. So this is a profit before tax. Then we're told that our tax element is in the, if you come down here, we're told the tax is 20% for both years, right? For 2023, if you apply 20%, if you apply 20% on the 220, if you apply 20% on this figure here, right, you come and get this figure here, this income tax, this one that they've got in here, right? You come and get this one here. Good. So that is it. So 20% will give you the same thing. Besides, we said there's nothing wrong, there's no error with what? 2023. So you get the same 44,000. Then we go to 2022. So 2022, we now apply the 20% on the 190,000, right? 20% on the 190,000. We are not going to be using this one again, right? We'll not be using it again. We are now going to apply 20% on the new adjusted net income before tax. So when you apply 10% on the 190, you get 38,000. You get 38. 38,000. So 38,000 is your tax for 2022, right? Then when you less the tax from the net profit before tax, we are going to have profit after tax of here. We are going to have 176,000, the same in the question because it's not affected. And then here, when we deduct, we are going to have 152,000. So 152 is a revised profit after tax, right? That's a revised profit after tax. As simple as that. So we are done revising. Then we can go to our retained earnings and go and do the adjustment, right? Very good. Now let's look at method two. With method two, okay, if you want to use method two, this is how you do it. We are going to use the net profit. Okay, so we'll pick, so method two, I'll just pick the net profit. I'll use the net profit. So with method two, I'll bring my net profit here, right? And the error is with only 2022. Okay, here it's not like inventory where the closing inventory affects, or closing inventory of 1 year is taken to the other, right? If the error involves inventory, you realize that if closing inventory is affected, the opening inventory for the following year also be what affected, because the closing inventory of 1 year becomes the opening inventory for what the following year. So normally errors with inventories, they normally affect more than 1 year. Are you following? But with this depreciation, it's just 2022. So we corrected the error in only the 2020 what? 2. Net profit of 2022, how much the net profit? So here I said I'm using the net profit method, right? And that's the method 2. So net profit, I'll go and pick the net profit before the correction of the error for 2022. How much is it? 168,000. Okay. Then let's go and do the impact. Let's check the analysis. We said the error was that instead of recording 50,000 as depreciation, we recorded 30,000. So let's do the analysis, then we can correct the error. Let's check the analysis on profit. Instead of recording 50,000 as what? Depreciation, we recorded 30,000. What are we doing? We are reducing our expenses. We have reduced our expenses by what? 20. And if you reduce your expenses, what happens to profit? Profit increases because you are reducing your profits. You are deducting smaller. Sorry, you are reducing your expenses. When you reduce your expenses, profit what? Increases. When you reduce your profit, when you reduce your expenses, profit increases. Why? Because you are lessening a smaller expenses from revenue. So your profit will be what? High. So when you reduce your expenses, profit what? Increases. So to correct it, we have to go and less it because the error will lead to overstatement of profit, right? So this one we have to less the depreciation, the extra, which is the 20,000, right? That's the 50,000, 50K minus what? The 30,000, and that's the 20,000. So that 20,000 difference should be what? Less. Why? Because we said it has overestimated what? Our profit. When you reduce expenses, you are overestimating your profit. So you have to less it, right? And here there's a tax element. Here there's a tax rate in the question, 20%. Now, what can we say, or what are we going to do? We said that if we are correcting the error by lessening the error, we have to add the tax component. If you are correcting the error by adding it, they have to less the tax component. So it's the other way around. It's like the other side. Mm? The other way around. Okay, is the inverse. If you are correcting the error by lessening the error, add the tax element. If you are correcting the error by lessening the error, add the tax element. If you are correcting the error by adding the error, they have to less the tax element or the tax component. So it's the other way around. So here we are correcting the error by doing what? By lessening it. So we have to add the tax element. right? So we have to add the tax element. And how much is the tax element? 20%. Okay, 20% on the difference. So what will be 20% on 20,000? 20% of 20,000 is 4,000, and it should be added. Why are we adding the 4,000? Because we have lessed the error. So you see that when you do this thing here, you pick your calculator, you underline, you punch, you should get the same answer as the method what one. So you should get the 152 back, 152,000. So these are our adjusted profit. Okay, these are our adjusted profit. You see that you get the same thing, right? So you should know both methods. Okay, are you correcting the error from the expense side or in the main statement, or you are using the net profit to correct what the error? So let's go and readjust. Let's go and do the financial position, the retained earnings, right? There is, when you check retained earnings, it's just like retained earnings is the same as like profit, accumulated profit. So with the retained earnings, if profits affected, retained earnings was likely to be affected. So let's say 2023 here and 2022. Okay, so here's 2020 what 2. What is the opening balance? So let's check the opening retained earnings. So with the opening balance, come to 2022 here, we have opening balance of what? 50,000. Opening balance of what? 50,000 for 2022. Okay, so let me come and do 2022 here. You can change it. So we have to do 2022. Then the closing of 2022 is what we take to 2023. So 2022, the opening is what? 50,000. It's in the question. Okay. Then what is profit for 2022? We have to add it. You add profit to the opening retained earnings. Okay. So our profit for 2022, the adjusted one is 152. You have to use adjusted profit. 152,000. So when you add 152,000 to 50,000, you get 202,000. So 202,000. So you get 202,000, right? As the closing for 2022. So for 2022, we brought the opening 50,000 and we added the 152,000 profits, right? Then when you go to 2023, when you go 2023, is the opening of 2022, which is 202. Are you following? So the opening of one year becomes the closing of one year becomes the opening of what the other year. So you have 202,000. Are you following? Then that's the opening for 2023. Then profit for 2023 is what? The profit for 2023, the profit after tax 176,000, right? So 176,000. So that's profit. Then you add to the opening, and then you have your closing for 2023. So we start with 2022. So here, when you add this to this year, you get 202 plus 176, right? So you pick your calculator, 202 plus 176, and that's 387. I'm getting 387,000. So 387,000 is my, or it's the closing retained earnings, right? So that is that. Very, very simple. Okay, very, very simple. Three, okay, 378 rather. 378. So when you add 202,000 plus 176, you get 202 plus 176. 202 plus 176. So you get 378,000, right? So that is the That's the readjusted or the revised retained earnings. Now, if you check something here, the tax element, you see, when we were or during the error, look at the income tax. It was what? 42,000. So when the error was committed, okay, the income tax for 2022 was what? 42,000. But after we've done the correction, look at the income tax, 38,000. So can you see the difference between the two income taxes? 44,000, right? When the error was what? Committed. 44,000 when the error was what? Committed. 42,000, right? When the error was committed. So when the error was committed, the when the error was committed, the income tax, okay, was what? 42,000. Without the error, if you come here, after correcting the error, the income tax is now what? 38,000. So can you see that is the same as this 4,000 that we've what? Added back? Can you see it's the same as the 20%? Are you following? Because if we made the error and the error has reduced our expenses, okay, and for that matter, profit increases, tax is also likely to what? Increase, because we pay profit based on tax. That's why the tax figure when the error was committed, it was what? 42, and without the error was what? 38. It was because the error reduced our what? Expenses and increase the profit. So if profit increases, the tax was what? Increase. That's why we paid bigger tax here. So you realize that the difference between the 42,000 tax when the error was made and the 38,000 when the error was what? Corrected is the what? The 4,000 that we what? Added back. That's why I'm saying if you are correcting the error by lessening the tax, I'm sorry, if you are correcting the error by lessening the error, add the tax. If you are correcting the error by adding the error, if you are correcting the error by adding the error, then you less the what? The tax, right? So that's it.